Welcome to the Deep Dive, the show that gives you the shortcut to being well-informed. Today, we're diving into a cryptocurrency that tried to solve what is, I think, the biggest usability problem in the entire digital currency space. Speed, exactly. We are talking about Dash.
That's right. I mean, when most people think crypto, they still think Bitcoin, which is like digital gold, slow transactions. But Dash didn't want to be gold. It wanted to be actual digital cash. The whole foundation of Dash is built on prioritizing usability and near instant confirmation so you can actually use it at a shop.
Right. Unlike the big coins that can leave you waiting at the register for 10, 20 minutes.
Or more.
So our mission today is to uncover the engine that makes all that speed possible. We're talking about the masternode network and InstantSend technology. Then we're going to look at a really compelling case study of its adoption in Venezuela. And finally, we'll get into the necessary debates around Dash's governance, its optional privacy feature, PrivateSend, and what some cutting-edge machine learning models are telling us about its market moves.
And we've got a lot to work with. White papers, adoption stats, the technical arguments comparing it to rivals like Monero.
Yeah.
So let's start with that fundamental problem Dash set out to fix. The sources all emphasize that transaction time is the true bottleneck for mass adoption.
It really is.
I mean, think about it. A traditional Bitcoin confirmation averages 10 minutes. But if the network's busy,
forget about it.
It can stretch to 20 minutes, maybe even an hour. Even Ethereum, which is faster, you're still looking at around 4 or 5 minutes on average. Nobody's waiting that long for a coffee.
Absolutely not. So this is what spurred Dash to engineer a solution they called InstantSend. And their promise was, what, confirmation in under 2 seconds?
Under 2 seconds. And that's not just an authorization, that's final transaction confirmation. That's the speed you'd expect from a credit card, but, without the central bank in the middle.
And that speed, it wasn't just a cool technical feature. It had profound, really life-altering consequences, especially in places with hyperinflation.
Oh, absolutely. The prime example is Venezuela. I mean, their currency, the bolivar, was basically melting. We're talking 6-figure inflation rates.
Unimaginable.
People were desperate for a reliable store of value, and just as important, a reliable way to actually pay for things day to day.
And Dash just stepped right into that void. The speed of InstantSend meant vendors could accept payment without worrying the value would, evaporate before the transaction even cleared.
And Venezuela became Dash's number 2 market. Globally.
Which is incredible, ahead of huge markets like China and Russia.
The growth metrics were just staggering. At its peak, you see reports of Dash signing up an average of 200 new vendors a month.
And these weren't just small shops, right? We're talking big international brands.
Subway, Calvin Klein. I mean, the CEO was reporting tens of thousands of wallet downloads every single month.
They even doubled down on that usability, partnering with Crypto Mobile.
Yeah, to produce smartphones that came preloaded with the whole Dash ecosystem. That was a huge strategic move, projected to add another 10,000 users a month.
The whole Venezuela case study just shows that for crypto to work as cash, speed isn't a luxury. It's everything.
Which brings us to the next big question. How do they actually do it? How do they handle all those transactions without getting congested like other networks?
And that brings us to the core technology. The masternodes.
Exactly.
So masternodes are the secret sauce, but what are they really? Because I look at the requirements. You have to hold an 1,000 DAH as collateral. Doesn't that sort of centralize power with wealthy stakeholders?
That is the central tension of the entire design. And you could argue it's a necessary trade-off for the speed they deliver.
Okay.
Masternodes are basically just servers running on the network, and yes, they require that 1,000 DHH collateral. Now, critically, that money stays in the user's control. It's not locked away forever, but that high barrier to entry is what's supposed to secure their reliability.
And in return for that commitment,
a huge incentive. Masternodes get about 45% of the total block reward for their services, facilitating InstantSend, the optional privacy features. They're not just volunteers, they're a highly incentivized professional layer of the network.
Okay, so their main job evolved from just coin mixing to providing this instant transaction finality. Let's break down how that InstantSend mechanism actually works.
It all centers on something called transaction locking. When you start a transaction, the network immediately declares its intent to lock those funds from the sender to the recipient. This is the key step to prevent double spending.
So you don't have to wait for a miner to put it in a block 10 minutes later? The masternodes handle the confirmation right away?
Correct. For any given transaction, a small group of masternodes, a quorum they call it, is algorithmically chosen. They're the instant locking authority.
And they vote on it.
They vote on its validity, And consensus is reached almost immediately when a 60% supermajority of that quorum agrees.
So once you hit that 60% threshold, what happens?
A cryptographically signed message is broadcast across the whole network. And at that point, the transaction is locked. It's final. The risk of a double spend is gone, right then and there, long before it ever gets mined into a block.
That decoupling is the real innovation here. It enables what the sources call no-wait client-to-client transactions.
Exactly. The huge win for usability is if you just receive funds via InstantSend, you can immediately turn around and spend them. They're guaranteed by the masternode network, not just by hoping a block gets mined soon.
And that's the backbone that let Dash go from just another niche coin to a viable digital cash system. So let's pivot to the history because it's fascinating and it leads to this whole privacy paradox. Dash didn't start as Dash.
No, it started as Xcoin and then a bit more notoriously as Darkcoin.
Darkcoin. That name tells you a lot about its initial focus.
It tells you everything, right? It was all about privacy, anonymity. The creators changed the name to Dash Short for digital cash in 2015, specifically to shed those negative dark web associations and focus on speed and usability.
But the privacy feature, PrivateSend, is still there. It's just optional now.
It is. It uses a decentralized coin mixing method, sort of an extension of CoinJoin, where master nodes mix up funds to obfuscate the transaction trail.
And that decision to make it optional is so interesting. It's a huge contrast with something like Monero, where privacy is always on by default.
Or Zcash, which uses really complex zero-knowledge proofs for its privacy. Dash gives you the choice. But that choice comes with some technical scrutiny.
And that's the paradox. One researcher pointed out that PrivateSend isn't perfect. They claimed that if a user reuses a single address for their deposits, something like 5 to 15% of those transactions can be traced with almost 100% certainty.
And that really highlights a structural limitation. It's a trade-off. You get incredible speed and an incentivized network, but your privacy guarantee is optional and it's subject to user error, like address reuse. Even respected cryptographers like Andrew Polstra were skeptical early on, publicly calling the initial implementation flawed.
Which leads us right into the governance structure. Dash was one of the very first decentralized autonomous organizations, a DAO. But critics argue that because of that 1,000 DAH requirement for masternodes, it acts more like a corporation run by the wealthy.
And I mean, the critics have a point when you look at voting power. But the governance structure is arguably its most profound innovation, maybe even more than InstantSend.
How so?
The mining reward isn't just split between miners and masternodes. It's 45% to miners, 45% to masternodes, and then 10%.
The last 10%.
That 10% is immediately channeled into a treasury to fund improvement proposals, or DIPs.
So 10% of every single block mined is earmarked for self-improvement. That's enormous.
It completely changes the game. The masternodes vote on these proposals. So Dash has this self-sustaining treasury built right into the protocol. It ensures that development and adoption are funded internally year after year without relying on donations or outside venture capital. It literally pays for its own evolution.
Wow. The currency is designed to fund its own future. Okay, let's switch gears to the market side. With crypto's volatility, traders are always looking for an edge.
And our sources highlight just how volatile it is. I mean, for context, Bitcoin's return volatility is 69% greater than crude oil's.
Which is wild.
That volatility drives huge interest in predictive modeling, and a recent study looked specifically at how well machine learning could predict DHH prices over a 4-year period.
And they were feeding the model standard stuff, right? Things traders actually use.
Exactly. The 50-day simple moving average, MACD, RSI 14, they're all indicators related to trend following and momentum.
They tested a few different models, but one was the clear winner, LightGBM.
Yeah, LightGBM, which is a specialized model known for being fast and accurate.
So why did it do so well? It got an R-squared value of 0.82. What does that actually mean for someone listening?
So R-squared is just a measure of how well the model predicts the outcome. An R-squared of 0.82 is very high. It means 82% of the price movements in Dash over those 4 years could be explained by those simple trend following and momentum indicators.
That seems almost too predictable for crypto. Why would Dash be so easy for these models to read?
It comes right back to its identity as digital cash. Unlike a privacy coin where everything is hidden, Dash is designed for transparent commerce. Its public ledger and focus on stable, usable transactions means its price behavior tends to follow more traditional financial momentum signals. It's not operating in an information vacuum.
So pulling it all together, what's the big picture here? Dash successfully engineered this solution, InstantSend, that delivered on the promise of near-instant transactions.
Right. And that innovation let it move past being just a speculative asset and become a practical digital cash, especially in high-stress places like Venezuela.
The synthesis really is the masternode network, isn't it? It's the clever innovation that separates transaction finality from block confirmation, which gives it the speed it needs.
But that design comes with that clear trade-off we talked about. You get speed and this really interesting governance model, but you sacrifice mandatory, always-on privacy. PrivateSend is there, but its optional nature and flaws set it apart from its rivals.
And I keep coming back to that 10% self-funding mechanism, this governance system where part of every mining reward is funneled into proposals that masternodes vote on. It creates a totally different competitive landscape. So here's the thought I want to leave you with.
Okay.
How does this kind of built-in funding designed to incentivize constant development from within change the long-term viability of a decentralized currency, especially when you compare it to systems that have to rely on the whims of venture capital or community donations? It's a structure that basically guarantees its own R&D budget forever.